Hello everyone, we are group number 8. Today we will be presenting our analysis on financial statement as a part of our advanced financial accounting module. Let me start by introducing the two key companies in our analysis. We will look at the Kingsbury PLC and Galadari Hotel PLC, two of Sri Lankan largest companies in the hospitality sector. The first one is Kingsbury PLC. The Kingsbury PLC is situated in the heart of Colombo at 48 Janajpati Mawatha. It was originally established in 1973 with a long-standing history in luxury hospitality. The company is primarily owned by Hayes PLC, Carbotels Private Limited and the Employer Provident Fund. It operates as a luxury city hotel well known for its high-end services and central location. Second one is Galadari Hotel PLC. The Galadari Hotel is located nearby at 64 Lotus Road, Colombo 1. It was established in 1984 and has remained a key player in the premium hospitality segment. The majority shareholders in Galadari Brothers Co. LLC holding over 63% of the company. Galadari is a recognized 5-star hotel offering a blend of business and leisure hospitality services. Now we can see the Kingsbury PLC and Galadari Hotel PLC company overview. First one is nature of businesses. Both companies are primarily engaged in the hospitality industry, focus on luxury hotel services, food and beverage options, banquets, conference and tourism related offering in Colombo, Sri Lanka. Second one is ownership structure. The Kingsbury PLC is public list company major owned by Hayes PLC, one of the Sri Lankan largest company. Galadari Hotel PLC also public list and is major owned by the Galadari Brothers Group based on UAE. Third one is stock exchange listing. Both companies are listed on the Colombo Stock Exchange under the hotel and travel sector. Fourth one is parent company. The Kingsbury PLC subsidiary of Hayes PLC. Galadari Hotel PLC subsidiary of Galadari Brothers Co. LLC Dubai. Fifth one is revenue 2023-2024. The Kingsbury PLC 3.9 billion approx. Galadari Hotel PLC 2.5 billion approx. Net profit 2023-2024. The Kingsbury PLC profit of approx 100 million. Galadari Hotel PLC reported a loss of approx 270 million. Next one is core business strength. The Kingsbury strength lies in luxury hospitality strategic branding under Hayes and premium positioning in Colombo. Galadari known for location, banquet facilities and long-standing brand presence destitute needing modernization. Next one is financial health. The Kingsbury shows strong financial resilience with positive profitability and support from a robust parent company. Galadari Hotel currently reflects financial challenges with ongoing losses and relatively weaker investor confidence.
Methodology. We collected data from the 2024 annual reports of the selected companies. These reports are publicly available and include audited financial statements such as the income statement and the balance sheet. This ensures the data we use is reliable and accurate. To analyze the financial performance, we categorize the ratio into 4 key areas. First one is profitability ratio. We use the following ratios to measure the company's ability to generate profit: gross profit ratio, operating profit ratio, net profit ratio, return on capital employed, return on equity. Second one is gearing or leverage ratio. These ratios help us understand how much the companies depend on debt. Debt to equity ratio, debt to total asset ratio, interest coverage ratio. Third one is liquidity ratio. These indicators show the short-term financial health of the company. Current ratio, quick ratio. Fourth one is efficiency ratio. These ratios measure how well the companies use their resources. Asset turnover ratio, inventory turnover ratio, creditor turnover ratio. This structured approach gave us complete view of each company's financial performance, financial position and performance, allowing us to make a fair and meaningful comparison. Purpose of ratio analysis. Profitability ratios measure the company's ability to generate earning compared to its expenses and assets. Help assess how efficiently the company is running and whether it is making sufficient profit. Liquidity ratios assess the company's ability to meet short-term obligation, pay its debts when they come due. Important for creditors and suppliers. Gearing solvency ratios evaluate the company's long-term financial stability and risk by comparing debt to equity. Important for understanding financial risk and dependence on borrower fund. Efficiency ratios measure how well a company uses its assets and manage its liabilities. It shows operational effectiveness. Example, how fast it collects cash from customer or how quickly it turns inventory into sales. Investor and market ratios help investors assess the value of company's shares, its earning potential and prospect. Useful for decision making about buying, holding or selling shares.
Galadari and Kingsbury. I'll explain 5 key financial ratios that shows how well each company is performing in terms of profit. Gross profit ratio. This ratio shows how much profit the company makes after covering its cost of sales. Galadari has a gross profit ratio of 46.3%. Kingsbury has a slightly better ratio of 47.3%. This means both companies are doing well in controlling their direct cost. Operating profit ratio. This ratio shows how much profit is left after operating expenses. Galadari's ratio is minus 16.26%, which is a loss. Kingsbury has a positive ratio of 10.49%. This shows that Galadari is struggling to manage its operating cost while Kingsbury is doing better. Net profit ratios. This tell us the final profit after all expenses including taxes. Galadari has a net profit ratio of 9.57%. Kingsbury has a 5.01%. Even though Galadari had the operating loss, it still reported a higher net profit, possibly due to non-operating income or tax benefits. Return on capital employed. This ratio shows how well a company is using its capital to generate profit. Galadari's ROCE is minus 2.51%, meaning it's not generating returns on its capital. Kingsbury ROCE is 16.43%, showing strong performance in using capital effectively. Return on equity. This shows the return to shareholders. Galadari has a low ROE of 1.77%. Kingsbury has a high ROE of 19.55%. This means Kingsbury is given better returns to its shareholders. Kingsbury performs better in most profitability measures, especially in operating profit, capital efficiency and shareholders return. Galadari shows a high net profit, but overall it's struggle with operational efficiency.
Liquidity analysis measures a company's ability to meet its short-term obligations using its most liquid assets. Two commonly used ratios in this analysis are the current ratio and the quick ratio. Galadari shows strong liquidity with a current ratio of 3.24 and a quick ratio of 3.16. This suggests the company has sufficient liquid assets to cover its short-term liabilities. Kingsbury, on the other hand, shows weak liquidity with a current ratio of 0.53 and a quick ratio of 0.46. This indicates potential difficulty in meeting short-term obligations without relying on inventory or external financing. This comparison highlights the significant difference in short-term financial health between the two companies.
Leverage analysis helps us understand how much a company relies on debt to finance its operations. It shows the balance between using debt and equity and how effectively a company can manage its debt-related obligations. Galadari Hotels shows low financial risks with a debt to equity ratio of 0.20, meaning it uses very little debt and relies mostly on equity. This makes it more financially stable and less exposed to interest rate changes or economic downturns. On the other hand, Kingsbury plc has a high debt to equity ratio of 1.46, indicating a greater reliance on borrowed funds. This raises financial risks, but it can also boost returns if the company manages the debt well. However, Kingsbury has a higher interest coverage ratio of 1.82 times, which means it can pay its interest obligation more comfortably than Galadari, even though it carries more debt. In summary, Galadari Hotel is more conservative and financially suffer, while Kingsbury takes on more risks for potentially higher returns, showing a more aggressive growth strategy through leverage.
These are tools used to measure how well a company uses its resources like inventory, money owned by customers, and assets to run its business and make money. They help us understand how quickly and effectively a company can turn its input into profits. In this comparison, Kingsbury plc is shown to be more efficient in its operation than Galadari Hotels. This means Kingsbury uses its resources more effectively to generate sales and income. Kingsbury has a higher inventory turnover ratio. This means it sells its stock faster than Galadari Hotels. Selling inventory quickly helps reduce costs such as storage and the risk of products becoming outdated. Kingsbury also has a better debtors turnover ratio. This indicates that a company collects money from its customer more quickly. Faster collection improve cash flow, allowing the company to reinvest in operation or pay off its own bills faster. Kingsbury uses its assets more effectively to make revenue. This means every dollar of assets brings in more income compared to Galadari Hotels. Kingsbury keeps less stock sitting around. It manages its inventory well, which saves money and keeps operations smooth. Kingsbury doesn't wait as long to get paid, so it has more cash available to the business or pay expenses. Kingsbury gets more value from what it owns. It's making better use to its resource to earn money. Overall, Kingsbury plc is more efficient in handling its day-to-day operations and managing its resources. This gives it a strong advantage over Galadari Hotels. It shows that Kingsbury is better at controlling its process, generating revenue, and maintaining financial health.
These bar charts comparing financial ratios of two companies, Galadari and Kingsbury, across 4 categories: profitability, liquidity, efficiency, gearing, and leverage. Profitability ratios. Both companies have similar gross profit ratios as 45%. Kingsbury outperforms Galadari significantly in operating profit, net profit, returns on capital employed, and returns on equity. Galadari even shows negative operating and net profit ratios. And the second one is liquidity ratios. Both companies have strong current and quick ratios, with Galadari slightly higher in both, indicating better short-term liquidity. Third one is gearing and leverage ratios. Kingsbury has higher debt to equity and debt to total asset ratios, indicating higher financial leverage. Kingsbury also has a notably higher interest coverage ratio, suggesting better ability to cover interest expenses. And the last one is efficiency ratios. Kingsbury shows superior performance across inventory, debtors, and assets turnover, indicating higher operational efficiency. Galadari has slightly higher creditors turnover. In summary, Kingsbury appears strongly in profitability, efficiency, and leverage, while Galadari shows better liquidity.
Now present the comparison between the Kingsbury PLC and Galadari Hotel PLC based on our financial analysis. Starting with profitability, Kingsbury clearly leads in key metrics such as operating profit ratio, return on capital employed, and return on equity. This indicates that Kingsbury is more efficient at generating returns from its capital and equity. However, when it comes to net profit ratio, Galadari outperforms, suggesting it converts a higher portion of revenue into profit, offering better profit margin. In terms of liquidity, Galadari Hotel shows a much stronger position with a current ratio of 3.24 compared to Kingsbury's 0.53 and a quick ratio of 3.16 versus 0.46. Galadari is clearly more capable of meeting its short-term liabilities without relying on inventories. When we compare leverage, Galadari again shows lower financial risk with debt-to-equity ratio of only 0.2. On the other hand, Kingsbury has a higher ratio of 1.46, meaning it relies more on debt financing. However, Kingsbury does have slightly better investors' interest coverage ratio, such that it can manage its interest expenses but with some risk. Lastly, on efficiency, Kingsbury outperformed with better inventory turnover, debt turnover, and asset turnover ratio. This means it's better at converting inventories and receivable into revenue and is more productive with its assets overall. So in summary, Kingsbury leads in profitability and operational efficiency, while Galadari stands out in liquidity and financial stability. Kingsbury might be a better growth option, but Galadari offers safer, lower risk profile. Thank you. Let's continue with next slide.
Let's see what are the key findings from our analysis. In profitability, Kingsbury PLC outperformed with higher operating profit, ROCE and ROE, showing it's better at generating returns. However, Galadari Hotel has a strong net profit margin, meaning it turns more of its revenue into profit. In liquidity, Galadari is clearly stronger, with much higher current and quick ratio, showing it better position to meet short-term debts without relying on inventory. Looking at gearing, Galadari has a lower risk, financial risk with a lower debt to equity ratio, while Kingsbury shown higher risk due to greater reliance on debts. Still, Kingsbury has a higher interest coverage ratio, meaning it can manage its interest payment. Finally, Kingsbury is more efficient with better inventory, debtor, and assets turnover, showing it uses resources and collect payment more efficiently.
In conclusion, Kingsbury is focused on high performance and profit. It grows fast but takes more risk by using a lot of debt. Galadari is more careful with money. It's stable, use less debt, and suffer during drought time. So choose Kingsbury if you want high growth and can handle some risk. Choose Galadari if you prefer safety and steady progresses. It depends on what type of investor or partner you want to be. Thank you for your attention.